Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're going to start off by talking about how Toronto and Vancouver are leading the way in Canada's housing affordability gains for September. It's quite interesting to see these two cities, often highlighted for their high real estate prices, showing some improvement in affordability.
Absolutely, Sandy. According to RateHub.ca's latest affordability report, both Toronto and Vancouver have recorded the largest improvements in home buying affordability last month. In Toronto, the average home price fell by $9,400, which lowered the required annual income by $2,130. This also brought down the average monthly mortgage payment by $58 to $4,917.
That's a significant change, Steve. And in Vancouver, prices also dropped by $8,300, reducing the required income by $2,000. It's a small relief for potential homebuyers who have been struggling with the high costs in these markets.
You're right, Sandy. The report shows that 11 out of 13 major Canadian cities saw improved affordability compared to August. This is mainly due to the decline in home prices, as borrowing costs have remained relatively stable, with the average 5-year fixed mortgage rate edging slightly down to 4.47% from 4.49%. The stress test rate also eased a bit to 6.47% from 6.49%.
It's great to hear that affordability isn't just improving in Toronto and Vancouver. Cities like Calgary, Regina, and Victoria also saw improvements, with required income dropping by about $900 to $1,100 compared to last month.
However, it's not all positive news across the board. In Montreal and Halifax, modest price increases pushed the income needed to buy a home up by $1,040 and $210, respectively. The broader market still shows some areas where affordability challenges persist.
True, but on the national level, the Canadian Real Estate Association reported that while national home sales fell by 1.7% from August, they were still 5.2% higher than a year earlier. That makes September the busiest since 2021. The national average sale price rose by 0.7% year over year to $676,154, with the MLS Home Price Index slipping slightly by 0.1% month over month.
And speaking from a numbers perspective, the RateHub.ca report highlighted that the lowest 5-year variable mortgage rate narrowed to 3.70%, which is the lowest since mid-2022. The best 5-year fixed rate is at 3.79%. On a home priced at $676,154, the variable rate could save about $84 per month or $1,008 per year, while the fixed rate savings are estimated at $233 per month or $2,796 per year.
That's quite a bit of savings, Steve, and while the affordability gains in Toronto and Vancouver are indeed the most pronounced, it's good to know that homebuyers in many markets experienced at least some relief. The combination of lower home prices and stable borrowing rates is helping reduce income thresholds and monthly payment burdens this past September. Now, shifting our focus to local housing construction, it seems like there was a notable decline last month. Greater Vernon, in particular, saw quite a drop. The Canada Mortgage and Housing Corporation reported only 9 housing projects were started in September. That's down from 53 in August, and even from the 20 projects started in September of last year.
That's a significant decrease, Sandy. The report highlighted that these 9 projects included 5 single and 4 semi-detached homes. While the monthly numbers are down, it's interesting to note that year-to-date, Greater Vernon actually started 182 housing projects, which is an increase from 137 the previous year.
Right, Steve. So, despite the monthly dip, there's still some positive momentum over the year as a whole. However, it's important to look at the broader picture. Kelowna, for instance, started 95 new projects in September, bringing their total for the year to 2,132. But similar to Vernon, this is also a decline on an annual basis.
It seems like a trend across British Columbia, Sandy. The province saw 2,922 housing projects initiated in September, down from 3,461 the same month last year. Year to date, 31,761 projects have started, which is slightly lower than the 32,253 from the previous period.
Despite these declines in British Columbia, Canada as a whole saw an increase in housing construction. The Canada Mortgage and Housing Corporation reported 22,375 housing starts across the country in September. That's up from 18,806 starts in the same month last year.
That's an interesting contrast, Sandy. Nationally, a total of 178,035 housing projects have started this year, which is up from 168,442 during the first 9 months of last year. It seems like while some regions are experiencing slowdowns, the national market is still moving forward.
Absolutely, Steve. It's fascinating to see how these trends play out differently across regions. While Greater Vernon's monthly numbers are down, the annual growth shows there's still a demand and movement in the market. It'll be interesting to see how these trends evolve as we move into the last quarter of the year. Let's dive into the topic of rising mortgage delinquencies. The Canadian Mortgage and Housing Corporation, or CMHC, has been keeping a close eye on this trend as delinquencies have been slowly increasing after hitting recent lows.
That's right, Sandy. Aled Bjorworth, the deputy chief economist with CMHC, mentioned to CTV.ca that his expectation is for delinquencies and arrears to trend upwards across Canada. He pointed out that the higher interest rates on mortgage renewals are putting some downward pressure on the economy.
It's interesting to note, though, that even with the increases, the delinquency rates are still quite low compared to some previous years. For instance, back in 2012, the rate was at 0.38%, while in the recent quarters, it's been hovering around 0.20 to 0.23%.
Exactly, Sandy. And if we look at Montreal specifically, the numbers are telling. The delinquency rate was at 0.33% in the third quarter of 2012, and it peaked at 0.40% in the first quarter of 2016, but it dropped to a low of 0.09% in early 2023. Since then, it's been creeping up again, reaching 0.17% in the first quarter of this year.
It seems like the housing market is really feeling the impact of these economic shifts. Aled Ab Yorworth also predicted that the interest rates for individual homes and condos could be 3% higher than they were in 2020. That's a significant jump for homeowners to manage.
Absolutely, Sandy. Higher rates can be a big challenge for those renewing their mortgages or looking to enter the market. It's crucial for buyers and homeowners to stay informed and plan accordingly to manage these financial changes.
Definitely, Steve. It's all about preparation and understanding the market dynamics. With the current trends, it's important for everyone involved in the housing market to stay informed and proactive in managing their finances. Let's delve into the recent comments by Benjamin Tal, the Deputy Chief Economist at CIBC, who has made some striking statements about Canada's current economic state. According to Tal, Canada is currently experiencing what he calls a per capita recession. He believes that rate cuts are urgently needed to address this situation and to help thaw what he describes as a frozen housing market.
That's an interesting perspective, Sandy. Tal's remarks came during the Mortgage Professionals Canada's National Conference in Ottawa. He emphasized that while it may not be a formal recession, the impact on a per capita basis is significant, particularly in regions like Ontario and British Columbia. This slowdown seems to be a normalization after years of what he terms abnormal economic and housing conditions.
Right, Steve. Tal also pointed out that the abnormal period was largely influenced by trade tensions, particularly with the United States under President Donald Trump's administration. He referred to tariffs as a hidden tax on consumers, contributing to inflationary pressures.
Yes, and Tal seems to suggest that the US will eventually find a balance in its trade relationships, but not without some long-term damage to global supply chains. He mentioned that Canada's effective tariff rate with the US could rise as trade agreements are renegotiated, impacting various sectors differently.
Tal also believes that inflation has fallen back to its target, and he argues that monetary policy is currently too restrictive for an economy that's clearly stalling. He predicts a 25 basis point rate cut at the next Bank of Canada policy meeting, with the possibility of another cut in early 2026.
That's a bold prediction, Sandy. According to Tal, the Bank of Canada has the green light to reduce interest rates, which could provide relief to households facing higher mortgage renewal costs. He warns that without rate cuts, many could see their mortgage payments increase significantly.
The housing market is another key focus for Tal. He describes it as frozen, with homes being too expensive to buy and not lucrative enough to build. The condo market, particularly in Ontario and British Columbia, is in recession, with prices dropping significantly.
Tal highlights the need for fiscal policy to stimulate demand and supply in the housing market. He has called on the federal government to expand GST/HST relief beyond first-time buyers to make a broader impact on affordability.
He also raised concerns about underestimations in Canada's population growth, which affects housing supply planning. Tal suggests that the government's move to convert non-permanent residents to permanent status could positively impact the housing market and economy.
Tal's outlook is cautiously optimistic. He expects that a combination of lower rates, federal spending, and eventual stability in U.S. trade policy will help lift the economy in the coming years. It's a challenging period, but Tal believes we're nearing the bottom.
Let's dive into the recent comments made by Federal Housing Minister Gregor Robertson that have stirred up a long-standing debate on housing prices. Robertson spoke before the House of Commons Finance Committee, suggesting that average housing costs need to come down to make home buying more realistic for younger Canadians. He emphasized the need for more non-market housing to bring those average costs down.
It's an interesting point, Sandy. Robertson stopped short of calling for an outright drop in individual home values, but highlighted the importance of building more affordable housing. This has been a consistent theme, yet his comments haven't been universally well received, especially within the mortgage industry.
Indeed, Steve. Butler Mortgage founder Ron Butler criticized Robertson's approach, suggesting it tries to appease both homeowners enjoying high property values and young Canadians struggling to enter the market. Butler even called Robertson's stance a ridiculous lie, highlighting the tension between maintaining property values and addressing affordability.
And let's not forget Prime Minister Mark Carney's stance on this issue. He previously mentioned there's no straightforward answer to whether home prices need to fall. This nuanced approach has sparked criticism for being out of touch with the struggles faced by younger Canadians.
Ryan Sims, a mortgage agent, echoed this sentiment, pointing out that younger Canadians, especially first-time homebuyers, believe prices need to come down. Meanwhile, Canadian home sales fell by 1.7% in September, breaking a 5-month streak of gains. Yet, sales remain high for the month, with forecasts indicating continued momentum into 2026.
There's also been a debate about whether federal immigration policies have influenced the housing market. Robertson acknowledged that price growth isn't new, but he avoided directly linking it to immigration policies. However, CIBC's Deputy Chief Economist Benjamin Tal has been vocal about this, suggesting the rapid increase in immigration was too much for the market to handle.
Tal argues that while Canada needs immigration, the pace at which it was ramped up was too fast, impacting the rental market significantly. Despite this, some federal measures have found favor among brokers, such as expanding 30-year amortizations for first-time buyers and increasing the maximum insurable mortgage amount.
It's a double-edged sword, Sandy. While these measures increase borrowing capacity, they also encourage more debt. Montreal-based broker Jason Zuckerman pointed out that while longer amortizations can help, They also push people to take on more debt.
Balancing the needs of current homeowners with those of potential buyers is no easy task. Carney's government is trying to strike this balance, but it's a challenging endeavor. Affordability did improve in several cities last month, yet the income required to afford an average property in major markets remains high.
Tal suggests removing GST on all home purchases, not just for first-time buyers, could alleviate some of the costs. He argues that inaction would be more costly in the long run. It's a bold proposal, but it highlights the need for comprehensive solutions to the affordability crisis.
Now, let's pivot to the topic of the Canadian dollar and its recent performance in the currency markets. It seems that a hotter than expected inflation reading in September has given the Canadian dollar a bit of a lift.
That's right, Sandy. The Canadian dollar appreciated by 0.1% against the United States dollar, reaching around 1.4020. This comes after it hit a 6-month low just last week. The unexpected rise in Canada's Consumer Price Index, which went up by 2.4% year over year, played a significant role in this change.
It sounds like the rising grocery bills and a slower than expected decline in gas prices were key contributors to this inflation jump. This development might also influence the Bank of Canada's decisions regarding interest rates in the near future.
Absolutely, Sandy. While the Bank of Canada recently lowered rates to a 3-year low of 2.5%, traders are now reassessing the likelihood of another rate cut this month, which has decreased to 80% from 86%. The inflation surprise has steadied the Canadian dollar despite the global strength of the US dollar.
And it's interesting to note that Canadian bond yields responded as well, rallying across various maturities. The 2-year yields notably rose to 2.40%, showing that inflation surprises can keep traders on their toes.
Indeed, Sandy. The yield gap between 2-year Canadian and US bonds has now narrowed to just 105 basis points. This shift has traders rethinking how quickly Canadian rates might fall, highlighting the importance of watching inflation trends closely.
With central banks around the world focusing heavily on inflation data to guide their policy decisions, Canada's higher than anticipated inflation reading is a reminder of how quickly expectations can shift in the financial markets.
Precisely, Sandy. The rise in oil prices by 0.1% also underscores the role that commodity swings and inflation surprises play in shaping market dynamics and policy directions.
It's a complex interplay, Steve. These developments serve as a crucial reminder for investors and policymakers to remain vigilant and responsive to changing economic indicators.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.